Okay, good morning, everybody. Let's kick off and welcome to the Activeport FY25 update presentation. Appreciate everybody's time attending this morning. Let's get through this. I'm Peter Christie, the Chairman and CEO of Activeport, and Lisa is online to moderate. If anybody has any questions, please feel free to either type them into the chat window or raise your hand as best you can, and we can answer those questions at the end of the presentation. Okay, let's start with what Activeport does. We have a lot of questions about what Activeport software does for its customers, and I thought one of the ways that we could explain it, because it's a very large product, it has a lot of features and a lot of depth. But these are two examples that actually come from a proposal that we put to a data center operator in Europe just last week, in fact. So these are live, real-world examples of what our customers are asking to do with our software. In fact, this is the data center operator in Europe. It's probably the largest data center operator in Europe, the 5th largest in the world. And we're working on a project to orchestrate or set up an orchestration service for their network. And so these two examples, you can see the one on the left is where you have a data center in one location, data center in another location, Activeport software at the top there. Activeport software will automate the configuration of connectivity across the network between the two data centers. So from a rack 1 in data center 1 and rack 2 in data center 2, and then orchestrate connectivity to customers on those customer downlink lines. And so Activeport's purpose in that example is to provide a single pane of glass interface for a data center operator where their customers can automate provisioning of network services across their racks, across data centers themselves. So it's a self-service portal product for a data center operator in this use case. And on the right-hand side is an extension of that, where we are enabling the data center customer to connect their racks out to cloud services, AWS, Azure, Google Cloud, Oracle Cloud, etc. And so those two use cases are examples of what Activeport software does in the field for a data center operator. And that's a common use case that we find across telcos and a range of other applications in the world. Obviously, the data center market is a booming industry right now, and so there's a significant amount of demand coming through from those data center operators to provide a self-service interface for their customers to be able to provision services, order racks, make connections, connect to the internet, connect out to cloud service providers, etc. And so that's a couple of simple examples, but we do a lot more than that. Activeport software for the telco industry not only orchestrates connectivity between racks in data centers and from data centers out to customers, but we also orchestrate subsea fiber, we orchestrate GPUs, we orchestrate network-to-network services amongst telcos, and we provide operations automation for network ops centers, so NOC automation solutions as well. We have a broad range of security features, SOC, SIEM support, SASE support built into the product, SD-WAN services built into the product. So it's a very deep product. It's a comprehensive solution for data centers and telcos. And so if you look at the way our customers use Activeport, I think the first and most important feature of the product is that our telco and data center customers use it to generate new revenue. So in the world of software, you're either providing a software product that automates the back office, and there the cost of the software by the customer is compared against efficiencies that they might make. And in a tough market, that can be a tough sell. The other side of software, which is where we live, is in the customer-facing side of the business, where a customer uses our software to generate new revenue. And that's obviously a much easier sell. If our software costs $1 million a year and the customer generates $10 million of new revenue, then it's a fairly simple investment decision to make. And so we're in the fortunate position that our software is used by our customers to create new self-service products across their networks and their data center infrastructure. A feature of our product is that telcos can use it to augment their network. And so in the last decade, there have been a lot of what we call network as a service operators. Perfect example of that is Megaport, where they have extensive global networks of data centers that they can connect customers to. And a lot of our telco customers are using our software to bond their network with network as a service providers like Console Connect, Equinix, Megaport, etc., to give their domestic network more global reach. And so we call that network augmentation, and that's a very, very popular feature set of our Activeport software. We have a complete edge core cloud and GPU orchestration feature set in the product. We deliver GPU orchestration primarily for streaming, for interactive streaming or cloud gaming. We're looking to expand the footprint of that part of our product set into other areas where interactive streaming is important, applications like drones, robotics. And so that part of our product is a very important subset because very aligned with some of the current trends in the industry. And then customer retention and visibility. Customers in the telco data center space really use our product to maintain stickiness of their customers. So by providing a better user interface and a better user experience for their customers, it helps with customer retention. It provides their customers with better visibility of their network, better visibility of security risks on their network. And so our software is, on the one hand, is used by our customers to generate new revenue. On the other hand, it's used to make sure that the revenue remains sticky in their environment. When I evaluate software products myself as an investor, I always look for the features that make the product unique, because the more unique a product is and the greater the demand, the easier it is to get to cash flow positive, the easier it is to generate strong revenue growth in the market. And we're in a very fortunate situation with Activeport, where we have a highly an extensive product, very complete software product for the data center and telco sector. But it's very unique. Our vendor agnostic nature makes us one of the few orchestrators available on the market that can really orchestrate across an entire telco network, regardless of the technology vendors providing their switching equipment that underpins their network. And so our product is comprehensive with a complete enterprise feature set, and it's extremely unique in the global market right now because we have not come across another product that has the depth of features and the capability that we do have across multiple switch and router vendors. And so when we take our software to market, we have one software product and we sell it 4 different ways. On the left-hand side here, we talk about network orchestration, where we're cloud enabling networks for telcos and data centers. The second column across, GPU orchestration, we take a subset of our product and we use it to orchestrate GPUs. And then recently in May, June, we launched our network as a service product. So it's our same software, but we're using it ourselves internally to deliver a network as a service solution in Australia. And then the final column on the right-hand side is managed services. We deliver managed services, both to implement our software and integrate it with our customers' back office systems. But we also are offering a full managed network service for some of our data center operators where they don't have the internal expertise to manage a network themselves. And so it's one software product and we're selling it 4 different ways across the world. And so the focus for Activeport for the last 1.5 to 2 years has been to really build up our recurring revenue. Our new software sales are going really, really well. I think this last quarter, it was the first quarter where 56% or more than half of our revenue was generated from software sales. Our network as a service product that we launched is a lower ARPU product than our software to telco and data centers, but a much shorter sales cycle, and that's helping build a stronger recurring revenue growth rate. So we really are focused on building up that recurring revenue from our software products, and with that comes higher margins and free cash flow. And so if we look at some of the successes we've had in FY26, and these were successes that came to fruition just in the last quarter, and so we're yet to book most of this to revenue. But if I just tick a few of these off quickly, Telecom Malaysia, it's a multi-million-dollar project. It will go live at the end of August. And Telecom Malaysia are using our software to automate their global network. So Telecom Malaysia have a domestic network, like most telcos do in country, but they also have a quite extensive international network. And so the first project with Telecom Malaysia is to use our software to make it easy for other carriers to connect onto the Telecom Malaysia network through their global points of presence. So that's a fantastic project, and the Telecom Malaysia account should expand significantly over the next 12 months as they use our software to do more and more automation across other aspects and elements of their network. And of course, being in Malaysia with Johor and a few other regions is one of the hotbeds of data center growth at the moment in the world. And so there's a lot of opportunity coming from that project in the data center sector. Next one across is Reliance Jio. Reliance Jio, for those who aren't in the telco market, Reliance Jio have the largest domestic mobile phone network in the world. They have almost 500 million subscribers on their mobile network. Reliance Jio are rolling out a cloud gaming solution that uses our software to orchestrate their GPUs. They are looking to deliver 100 million subscribers on that cloud gaming network. The first 2 million subscribers will consume around 2,000 GPUs, and those GPUs are being deployed at the moment. Activeport software is sold to the channel partner there, Radian Arc, where we earn approximately $25 per GPU per month in license revenue. So the first tranche of GPUs at Reliance Jio should generate around $500,000 of annual recurring license revenue for Activeport. And of course, that's really just the tip of the iceberg for a network that's that large. So we're very excited about the Jio project. It did take a long time to close, but it is ramping up quite quickly. We can see the numbers of users on our cloud gaming network, the number of live game starts on an hourly basis increasing exponentially right now. So it's a fantastic project for us. If we move across to the third column, our SaaS customers, we launched our Global Edge self-service network in Australia back in May. And we did that in conjunction with FibreconX. FibreconX is a new fibre network in Australia, competing very aggressively with the traditional network operators, TPG, Vocus, Telstra, etc. It's a perfect fit for our software because as a wholesale network, it allows us to really flex the features of our software in a self-service environment. We set out to achieve 3 or 4 and then scale up to maybe 10 new circuits signed every month. In the first month, we signed 100 circuits, and we followed that up with another 100 circuits in the next month. And so we've been quite excited about the rapid take-up of that software as a service platform. We did talk in the last announcement about delivering our superhighway between data centers in Australia. That is a subset of our SaaS product, of our network as a service, and that's also taking off quite quickly. So the great thing about our SaaS platform is that we can add new features and new capabilities to generate new recurring revenue in fairly short order as we roll out new capabilities in that product. And then if I think about our global pipeline, we have some new salespeople on board. Our sales pipeline is growing very, very quickly. We have a range of new tier 1 telcos and data center operators coming on board in the first half, and they span the globe: Middle East, Europe, London, India, and Southeast Asia. And so our revenue growth heading into FY26 has been quite strong. The revenue that we booked, or the contract value of the revenue that we booked just in June alone, was in excess of $2 million. And so I think as we get through the first half and get these projects live and start to send invoices to these customers, we will see a significant step up in our annual recurring revenue, or monthly recurring revenue billings. And all of these projects have a scale factor. So all of these projects, as the utilization of the software grows, the license revenue that we achieve grows as well. And so as we add new customers, our recurring revenue steps up, but each of those customers themselves has a natural increment of recurring revenue built into the contracts. So on FY25 performance, if I look back, we achieved 11.2 million of gross revenue, including our R&D credits, and we will include those R&D credits in our revenue until we get past the $20 million threshold, and we don't receive those as cash. But while we receive those as cash, then for FY25, 11.2 million was the gross revenue. We had $14.5 million of an all-in cost base, and that's across R&D, all of our outgoings, the exit run rate for FY25 was 14.5 million. We did have a agreement to sell a perpetual license to Radian Arc for our GPU orchestration software for cloud gaming and telco. That option lapsed at the end of June. And really, given that we closed the Reliance Geo project with Radian Arc in June as well, our view is that the potential cash earning from just that project alone, let alone the other 50 telcos in that pipeline, should far and away exceed the $4 million one-off license deal. And so we're quite happy to let that lapse and just focus on collecting the recurring revenue from the GPU orchestration product. Had we booked that, we would have made a profit in both EBITDA and cash. We didn't, so there was a shortfall, but we're closing that gap very, very quickly. In FY25, as people will see at the end of when we put out the full year report, we are optimizing the balance sheet still. We've reduced a huge amount of debt to the point where the debt left is really just normal rotation of working capital. So the debt position on the balance sheet is far and away better than it was going into FY25. We will write down the majority of our goodwill just to eliminate future on-cash adjustments. We are continuing to look at equity-light facilities to grow the business faster because we do have a fantastic opportunity in front of us, and the more working capital we can generate to focus on software sales, the better. We've considered things like selling portions of our GPU subsidiary, for example, and other ways that we can generate more working capital to grow quicker. But balance sheet optimization FY25 has been a significant focus for us so that we're in a healthy position going into our FY26 year. And we have a very positive outlook across Q3 and Q4. We had stable revenue and costs with revenue up a little. Our objective is to generate recurring quarterly increases in revenue. And so we're in a good place to go from Q3 to Q4 as a slight revenue increase. Q1 FY26 is a higher revenue increase. Q2 FY26 is a higher recurring revenue increase. If we can start to put together back-to-back increases in quarterly recurring revenue, which I think the contracts we have in place will support, then I think we'll be in a much better place as far as market perception of the business is concerned. And so if I look at FY26 revenue and growth outlook, we did secure a number of new contracts in June, as I talked about. That will flow through to revenue and cash in the first half of this year. And we have a huge number of new projects in the pipeline that haven't been announced to the market yet that we should be able to close out in Q1 and Q2, which will just add more and more to this recurring revenue number. We have a number of tier one telco and data center projects commencing in H1. Those examples at the beginning of the chart that I showed you is with a fantastic operator that we hope to be able to announce soon as that project goes live. We have similar projects in India where the data center sector is really booming. We have some fantastic opportunities in network integration amongst telcos in Southeast Asia. And I think we're really well set to deliver a constant stream of announcements of new projects that we close through all the way through FY26. And we are looking to scale our sales team. I think what we do need to do quite quickly is make sure that we have a stronger presence in the Middle East. The Middle East data center market is booming right now. We have set up a technical team in India, and we'll complement that with a salesperson in India to really double down on our capabilities in that region and leverage the reference sites that we already have. And we have new sales team or new salesperson operating in the Asian market for us. And then we're considering how we enter the US. The US is a fantastic market. If I look at some of our peers like Megaport, where 2/3 of their revenue now comes from the US, we'd be silly not to try and tackle the market ourselves since we operate in similar spaces. And so we're considering ways that we can do that in a cost-effective manner. And also leverage some of our GPU capability. The work that the team have done with AMD to build out our GPU streaming capability is second to none. We've got a fantastic working relationship with AMD. AMD are booking some significant wins in the AI space, and we really need to leverage that. So a significant part of our focus in this first half of FY26 is to set up our entry point into the US and start to exploit the opportunities in that market as well. So if I think about our group objectives, we really want to hit that Rule of 40 performance. And so between FY26, FY27, I think we can get there. And that is one of the key capabilities that we do have as a software company, is to reach that Rule of 40 growth rate and hopefully achieve the outcome that we would expect from our share price if we do that. We're targeting $25 million of exit run rate revenue in FY26. If we can do that on the current cost base, we would have a $9 million EBITDA and $5 million of free cash flow. And so our objective from a revenue and cost perspective is to deliver a lot more revenue using the current team of people that we have on board. And I think we can achieve that. I think we can get to $25 million of revenue without pushing our cost base past $14 million, without pushing our cost base past $16 million. And that should deliver a really, really good result from a P&L perspective. And then our objective through the end of FY26 and FY27 is to deliver positive free cash flow. Like other software companies, we sell our software product at 85 to 95% GP. And so if we can accelerate our top line from here and keep constant cost base, then we've got every chance of delivering positive free cash flow in the near term. I've put this slide in here as what I call peer aspirations. And before people shout at me on hot copper about how we're not comparable to these businesses because of our size, that's not the point of this slide. The point of this slide is to provide investors with a guide as to the nature of our business. And the nature of our business is like other enterprise software operators on the ASX, where we have every opportunity to deliver very high gross profit, so above 85%, heading up into the 90s as we grow. We have the ability to deliver a significant EBITDA number on the back of that, above 30%. We have the ability to then generate significant net profit after tax and free cash flow. And if you look at the peers in this space, for example, WiseTech is a specialist in freight software. Activeport is a specialist in telecommunication software. Tech One, Objective, both enterprise software products. Activeport is an enterprise software product. Hansen's solution is based on a service bus for back office processing in utilities and telco. Activeport's core product operates off a service bus, and we deliver it into utilities and telco. Gentrack is similarly an enterprise billing product for utilities and airports, as Activeport's product has integrated billing for telcos and data center operators. And Megaport is a software-driven network as a service provider, just as Activeport is a software-driven network as a service provider. And so I've included these peers so that when people are looking at Activeport on the ASX and saying, well, what is this company and what is it likely to look like in the coming years? It should look like one of or all of these businesses, where we're generating $25 million of EBITDA of revenue in the short term, 84% GP, 36% EBITDA, 24% NPAT. If we can achieve those numbers, then if you look at the market cap to revenue across these peers, the median number is 13, which would deliver a $300 million market cap for us. And so we are very, very focused right now on trying to hit that revenue number, trying to make sure that we do it from a constant cost base to deliver the EBITDA and NPAT that will deliver that result for our shareholders. On that note, Lisa, questions?
We do have a few questions, so I'll work through them now. And if we don't get to all of them, I'll make sure we follow up after the webinar. Okay. So first question here, what is the typical lead time to close a telco deal?
Yeah, great. Yes, a lot of people ask that question. The telco deals can take more than a year to close. Two examples of that, I think Telecom Malaysia, we started the conversation 2 years ago. they agreed to go ahead in February of 2024, and it will be live in August of 2025. And so that's a really good example of a sales cycle in the telco space. Now, people say that's a long time, and it is. The benefit of it being a long sales cycle is that once you are the incumbent provider of orchestration software in a telco of that size and scale, then it's a lot easier for people within the telco to buy more features from Activeport rather than go out to market and look for alternate products. And so the barrier to entry is high, but the stickiness once we're inside is significant. But I would compare that to other operators like the project we're working on in London at the moment. That project from initial conversation to deployment is less than 6 months. And so there is quite a big gap between the longest sell cycles, which are spanning 1.5 years to 2 years, and the shortest sell cycles, which at the moment are around 6 months. I would say, Lisa, one of the reasons we launched our software as a service product in Australia is to try and balance those long sales cycles with shorter revenue cycles. And so our software as a service business generates fantastic recurring revenue, but the time to close a transaction in that sector and get a customer live can be as short as 2 weeks. And so we're trying to balance the larger, longer-term enterprise telco and data center sales with punchier, shorter, faster software as a service revenue growth as well.
Okay, next question. When you talk about contract value, is there a ramp up or is it evenly spread over the term?
Contract value ramps up, and it ramps up in 2 ways. So if you think about our customers, which are very large organizations, which you consider the size and sprawl of a company like Telstra, which on a global scale is a small telco. Some of our telcos, people like Reliance Jio, Saudi Telecom, Singtel, they're quite large organizations. And so we typically start with total contract value that's attached to a relatively small project within the ecosystem of telco or a data center operator. And then 2 things happen is those projects themselves are usually priced on some volume metric. So our revenue increases as the volume of traffic across that project increases. But then within the telcos or the data centers, there are new projects that come on stream that generate whole new sources of revenue within that same account. And those new sources of revenue also scale based on volume. So that when we talk about total contract value, we typically only talk about the contract value that we've booked, but there's natural growth within those contracts, and there's additional growth by applying the product to other projects within those same accounts.
Okay, now we have a few about Radian Arc. You mentioned not taking the 4 million from Radian Arc because of the Geo deal. Can you explain more about that and the expected revenue?
Yes, so the 2 things happen in the same month. The Radian Arc option to take a perpetual license for our software to deliver cloud gaming to telco lapsed at the end of June. But in June also, Radian Arc closed the Reliance Jio project, which is potentially the largest cloud gaming ecosystem on the planet, if not the largest gaming ecosystem on the planet. And so it's a significant project with a huge amount of upside in revenue for both Radian Arc and Activeport. And so we think that the NPV, if we think about the present value of the likely future license revenue from just that account, let alone the other 60 telcos that Radian Arc are delivering to, is well in excess of the $4 million perpetual license agreement that we were looking to execute. And so on the one hand, we're disappointed that the license agreement didn't close, because it would have been fantastic for our end of year numbers. But on the other hand, I think the revenue that we will earn from our cloud gaming software with Reliance Jio as the best reference site that we could possibly wish for, I think will be well in excess of $4 million over the short term. And so I think on the one hand, we're a little bit disappointed, but on the other hand, we're absolutely elated that we're rolling our product out to the biggest telco operator on the planet.
I think we've already touched on this, but another question, why do you invest so much time and effort into Radiant Arc projects?
Well, the early days, Radiant Arc had a fantastic channel to market for us because they've got such a mature sales organization globally, and they did introduce us to some amazing telco opportunities in the early days. As we've matured, we're doing a lot more of that ourselves, and so we're not so reliant on channel partners to introduce us to new customers, which is good because we're in more control of our own destiny as far as sales and revenue generation is concerned. And so in the early days, it was a fantastic relationship. More recently, when we test our commitment to the Radiant Arc relationship, obviously it pays off because of the projects like Reliance Jio. But also working with Radiant Arc has helped us build out a GPU streaming product that is second to none on the planet. If people go to there are, I always say this to investors, there are, in terms of moats, there are only two providers of GPUs in the world, is NVIDIA and AMD. And if you want an interactive streaming product and you go to NVIDIA, you'll get something like GeForce Now. But if you go to AMD, they'll send you an Activeport because we are their default partner as far as interactive streaming software is concerned on their cloud-based GPUs. And so I think the relationship with Radiant Arc has been fantastic because it's helped us focus our R&D efforts on building out a GPU streaming product that is world class. And I think if we can exploit other channels to market in the drone sector, the robotics sector in the US, I think that'll pay off in spades. And so, yes, we spend a lot of time working with Radiant Arc, but I think the end result will be a fantastic return for shareholders.
Okay, I'll keep going if we've got time. You mentioned looking to break even in H1. In the last 4C, ATV showed an operating loss of 700K. That is a big uplift in revenue. How much depth is in the pipeline, and when will you generate positive free cash flow?
So 700K was a lot less than 1.5 million. So I think the uplift capability sort of speaks for itself. The answer to the free cash flow question is there's two answers to that. First of all, when will we have line of sight to achieving it and sustaining it? And I think the answer to that is toward the end of the first half. When will we actually kick into free cash flow or positive EBITDA numbers and positive numbers at the top of our cash flow statement is the second half of FY26. It's obviously highly dependent on how quickly we can get projects live and how quickly we can turn those live projects into invoices and how quickly the customers pay the invoice. So there's a lot of factors in there that are not directly in our control. But we certainly have a fat enough pipeline across the telco and data center operators that we're deploying to hit that goal in FY26. If I think about it right now, we've got Jio and Telekom Malaysia and a few others. We've got three well-known brands in Australia in the telco and data center space that we're working with to map out implementation of our product. We've got three telcos, major telcos in Asia that we're working with right now, like today, in fact, to map out the implementation of our product. And some of those are in the process of onboarding us as vendors right now. And so we'll be able to announce those toward the end of FY20 towards the end of the first half. And then data center operators, we're working with some of the biggest data center operators in the world. The one that we're doing in Europe is the fifth largest data center operator on the planet. We have two data center operators in India that we're working with that have more than 40 data centers each. And so we're talking about data center operators that are significant in size and stature. And so we've got a very, very fat pipeline of enterprise customers. And coupled with that, our GPU revenue growth is growing strong, and our software as a service platform in Australia is delivering well beyond our expectations. And so I think we're perfectly positioned to get there. I've got no doubt in my mind at all that we will hit that free cash flow and an EBITDA positive number soon. And I would like to think that will be very obvious at the end of the first half.
And then I've got one here. How much revenue does Activeport expect to generate this financial year from both Global Edge platform and associated products of FibreconX?
The Global Edge platform, we had estimated 1.4 million for FY26. We have already booked more than that in. If I look at the total contract value we've booked in the first 2 months of selling the Global Edge platform, we've already far exceeded that target. And so I would like to think, now, obviously, there's a big difference between total contract value and how much revenue comes in the door, but I would like to think that we would hit $2 to $2.5 million of revenue for Global Edge in the first 12 months.
Okay, that's all the questions I have right now, Peter.
Perfect. All right, appreciate it. So if there's nothing else, Lise, then we'll wrap it up. Thanks everybody for your time.
And sorry, Peter, if we get any further questions, you feel free to email us at investor.relations@activeport.com.au. Thanks.
Fantastic. Thank you.